Welcome, I'm Mark Todd from the NAB, and in this NAB Trade Investing Basics video, I'd like to talk to you about exchange traded funds or ETFs, what they are, how they work, and the role they can play in your portfolio. Exchange traded funds or ETFs are an investment vehicle that has experienced rapid growth in popularity since originating from North America in the 1990s. They are essentially investment funds traded on the stock market. They are designed usually to track the performance of an index or mirror the price of an asset such as gold or oil. Think of them as boxes of chocolates. Rather than investing the energy and effort into buying each piece individually, you purchase the whole pack and get a heap of different flavours all at once. That saves you time and allows you to focus on asset allocation. While most ETFs are passive, in recent years we've seen a trend towards two interesting types of products within the ETF market. The first of these are strategy-based ETFs, which use various screens to filter a universe of stocks and select those with the highest potential to deliver that fund's objective. For example, this could be selecting high dividend shares or stocks that exhibit low amounts of volatility. And second, you could then have active ETFs known as exchange traded managed funds, which are simply actively managed strategies trading in an ETF structure. The benefits of ETFs include intraday trading flexibility, so you can buy them like any other shares, instant diversification to whole markets and asset classes, low management fees as they're generally passively managed. You can access their holding data on a daily basis. There's no minimum investment requirement, so they make it easy to get started in the market, and they pass through any income they collect to the end investor. So you do need to think about some risks when it comes to ETFs. These include liquidity. The liquidity of ETFs are a reflection of the liquidity in the underlying asset they hold. So if an ETF is investing in assets that are not very liquid, then it may take time to buy and sell the ETF. There's the currency risk. If the ETF tracks overseas assets, changes in the value of the Australian dollar may also affect the value of the ETF investment. You can get currency hedged ETFs as an alternative. And there's physical versus synthetic ETFs. You need to think about whether you're comfortable with an ETF using a physical replication approach, which involves buying the underlying companies that make up the benchmark, or a synthetic replication approach where ETFs use derivatives to obtain their exposure. There are several ways I've seen investors use ETFs. There's the core satellite approach to creating diversity in their portfolio. Some investors will use a bundle of broad-based vanilla ETFs or LICs or managed funds or a combination of all three. Then to generate alpha, they may tactically invest in more specific funds such as technology or Japanese ETFs. And there's portfolio completion ETFs can be used to fill both large and small gaps in portfolio. For example, you could be knowledgeable in building a portfolio of large caps yourself, but use the ETFs to access small cap or global equity exposure. ETFs are valuable investment that enable investors to quickly, efficiently and cost effectively implement a variety of strategies. Still, these products have risks and some have complex features that must be kept in mind. So it's important that you ensure you understand them and consider seeking financial advice if you do need help in getting started in this part of the market. I'm Mark Todd from the NAB. Good luck with all your investing. I hope you've enjoyed this ETF video.